Okay, as I'm continuing through the webinar here, if you have any questions, if you want to just go ahead and type them in the question box. Yes, I used to teach through Pacific Trading Academy. If you go ahead and type in a question box, I will answer them, try to answer them immediately so you're not pondering and sitting there wondering as I'm continuing through my webinar. So today's topic is going to be monthly income with credit spreads. Credit spreads is the trading strategy that we use on Options Infinity to teach people how to generate income on a monthly, even a weekly basis, on a consistent basis. What I'm going to talk about today is, first of all, I'm going to go over some of the results that we've had trading the RUT, which is the Russell 2000. Talk a little bit about the time value of decay of options, why I trade this wealth building strategy, what are bull puts and bear calls quickly, choosing credit spreads that are worthwhile, not just any stock, but the stocks that make sense. What are some of the indicators that I use? Going to be going over the trading rules. One of the important things, well, actually there's two very important things to allow people to become a success in trading. One is don't overtrade your account, and two is establish trading rules and follow them to the T. Then I'm going to be going over some actual trades we've made just recently, where we pulled in 115% on a Google bull put, 108% on an Amazon bear call, and currently we're, it says currently 60%. We're currently about ready to close out at SPX bull put, and it's sitting at about 80%. Then I'm going to show you how you become a free member. You don't have to spend a lot of money to come see what I'm all about, see what whether this makes sense to you. Like the previous speaker was talking about, it's got to make sense to you. It's got to fit with what your trading style is. And if you like what you see there, I've got a lot of education for free. And then there are two programs that I offer. They are both sold out at the current time. We are opening them up at the end of the month, and I'll talk about that towards the end. As Renee said, I've been a trader for 35 plus years. I run my own hedge fund. I've been a keynote speaker with a number of different people. I have written 3 financial books. I am the founder and head trader of what I believe is the very best stock and option education website available today, and that is www.optionsinfinity.com. I get a big kick out of teaching. I'm not one of the people that teaches because I don't do. I'm a doer that has been very successful in an arena where it is hard to be a success. I get a kick nowadays out of teaching people how to be a success, how to wade through the myriad of problems that you might come up against and be a success in this arena. www.optionsinfinity.com. So let me talk to you a little bit about the Russell 2000 credit spread history. I call these theta trades, and because what you're doing is you're taking advantage of the rapid decay of theta that happens in the last 30 to 40 days before expiration. Theta is a large indice. It's trading at a very high level. You get nice credit spreads when you do that, And one of the things I look for when we set up a monthly theta trade is, can I do an iron condor, which is a bear call and a bull put together, so you get twice the credit you would if you pick a direction. The results since the beginning of this year is 115% per month with 100% winners. Well, that's now 6 for 6, 100% winners. This trade has returned in 2000. You say, well, this has been an extraordinary year. Well, indeed it has. But in 2016, we returned 92% per month with 75% winners, 9 out of 12. Now, one of my mentees went back and did an independent back test of this study, and I give a lot of credence to that because it's not me doing the back testing, it's one of my students, an independent study, and over a 10-year period from 2003 to 2012, he came up with a 79% winners, which is really unheard of. This is a chart from the simulated trading account, which I use to teach from. I'm not associated with Thinkorswim. I just happen to think they're an excellent trading platform. But you can see the first trade we had on this year was a bear call, and that was a profitable trade. Then we had an iron condor, 2, 3, 4, 5, 6, and then 7. Okay, and this is currently the iron condor that we have set up. So you can see this is a very consistent, very profitable strategy, but it's one of a couple that we used to run our this is the program we called Options Pro. Options Pro is teaching credit spreads on what I call the big five. The big five being Amazon, Google, Priceline, RUT, and SPX. But here's the independent back testing for 10 years, and you can see the kind of returns we got. 75 winners out of 101 for 75%. You can see the kind of returns we had on a monthly basis. Once again, this was an independent study of the strategy. Setting up credit spreads, what we're doing is taking advantage of the rapid time decay in options, especially in the last 40 to 30 days. You can see that an option is made up of both intrinsic value and extrinsic value. In extrinsic value or time value, and then you've got the real value. So the time value as it becomes closer and closer to expiration, that time value or the premium you pay just absolutely drops off the cliff. And if you set up a good credit spread or an iron condor during this period, time is working in your advantage. This is one of the strategies where you are the house. You are not the gambler walking through the doors and putting it on red or black. You are the house. And the house, you know the story about the house. The house usually wins. Now, I'm not saying we don't have losers. And like the preceding speaker, I think it's very important to dial in potential losers and make sure you don't overtrade. Why I trade this wealth building system. Like I said on the first slide, I do this for a living. I better be good at it. This is how I make my money. And I am so good at it that I feel very confident in teaching people how to do it. I've had a lot of very successful students who use this strategy on a monthly basis. You get great returns when coupled with probability approach to price action. It yields monthly income on a consistent basis. These are high probability trades. You have a high probability of success. What we're doing is selling premium. Time is money. We're selling premium. We're not chasing the market. We're selling the premium. You don't have to constantly watch the market. You don't have to, if you're busy working during the day, or even if you've got things to do. I mean, I am a professional. This is what I do for a living. I do not watch the market all day long. I've got other things to do. I like to play with the grandkids. I like to take care of other things. I like to take care of the house and so forth. And the strategies that I use do not require that you watch the market all the time. It gives you freedom, not only financial freedom, but freedom from the trading, the time it takes to trade. Credit spreads are low anxiety. One of the things I learned early on that is I love to get a good night's sleep. And if I have a feeling that I have a little anxiety over a trade, I know of either overtraded or I should get out. One of the things about credit spreads is you don't have to pick the right direction. It can either go in the direction you want, or it can go sideways, or it can come down a little bit and you still can be profitable. It's very low anxiety. And I set up protection from losses. I do not use stop losses. I do not use stop losses. I use mental losses, and I put them right on my chart. And when it goes past a certain barrier, I'll get an alert, and that's when I know it's time to look at the chart, see whether or not I think it's time to get out or what's to do. I don't put in a stop loss. I always use mental stops. Okay, I think most of you know what credit spreads are, but quickly, let me just go over the two main ones, and that is the bull put spread and the bear call spread. The bull put spread, basically what you are doing is at any given time, and you think that the market is either going to go up, sideways, or only down a little bit. You go below the market by a certain amount. You sell an option that is out of the money, and then you buy one that's further out of the money for protection. We never want to sell naked. You can look at the option chain and you can see, well, Dale, if you would have just sold, in this particular example, if you would have sold the 1800 put, and in this particular example, you would have collected $20.78. Why don't you just do that? Well, I'd rather have this insurance and buy one further out of the money and collect a less credit, because the brokers will require less margin when you have a bull put or a bear call on, because you have that protection. You can only lose a certain amount. You can only lose the difference between where you sold and where you bought, in this case 10 minus the credit. That's the max you can lose, okay? Whereas if you sell naked, you have unlimited loss potential. You never want to do that. Only the very professionals will ever attempt at doing that. And why they do, I have no clue. Because percentage-wise, you can make more money percentage-wise by doing credit spreads than you can by selling naked. Okay, the bear call is just the opposite. In the bear call, what you're doing is you are selling a call, which is out of the money, and then you're buying one further out of the money. In this case, we're selling the 1050 call and then buying the 1060 call further out of the money. And let's just take a look at this bear call. This was put on Amazon this year, June 9th of 2017. This was an actual trade. We put it on right here on June 9th. Now let's just take a look at this. The trade, the price of Amazon, we put on a bear call. In other words, we were bearish. We were bearish on Amazon at this point. Amazon reversed and came back up. Then it kind of went sideways, and then it started to go downhill. Well, all it took was a little dip downhill after all those days, and we profited about 80% on this trade. You can, again, with credit spreads, it doesn't have to go in the exact direction you want it to. It can go sideways or it can come down just a little bit. Have a quick question here. It says, if you do not put stop losses, then you have to focus 24/7 to satisfy your mental loss. Not at all. Not at all. With the credit spreads, they don't move as rapidly as if you just had a directional call or put. Now, I didn't say I completely ignore the market, okay? I spend a lot of time after the market closes in the evening, and then I refresh my analysis first thing in the morning, and I watch the market for about an hour when it first opens up. I don't make any trades once the market is open, because I already know what the analysis is, and I already know where my mental losses are. I'll come back and touch base with the market about noontime, and then I always watch the close. Most of the big boys, the institutions, the hedge funds are ruling the market between 3 and 4 o'clock. It's interesting to watch their action. And touching base with the market 3 times a day, knowing where the mental losses are, allow me to actively manage my trades. Good question. Good question. Okay, earlier I said I focus on 5, and I think there's 7,500 publicly traded stocks out there. And I think it's important for you to trade a small market basket of stocks. This allows you to focus on them, to not be constantly looking at different stocks and trying to have a strategy fit them. I could close my eyes and tell you exactly what Amazon is doing, what Priceline is doing, what Google, the RUT, and SPX are doing. These are the big 5. These are the ones I trade. Well, the biggest reason is they have the most credit that I can gain. I did a little study here, and what I did is I just went 43 days until the September expiration. I took a selling delta. I sold it at a delta of 0.1 with a 10-point spread, and I basically wrote down what credit spread could have I gotten. This was just a study. Amazon was at $995, Google at $990, Priceline at $1865, the RUT at $1380, and SPX at $2415. Look at the credit I could have received. Usually over $1 credit. You're welcome. You're welcome. Now, let's take a look at some commonly traded stock. DuPont, Nike, Verizon, Starbucks. They're all between $50 and $100. And look at the credit we're getting on those. Same spread, same delta. We're looking at 19 cents versus $1. So you say, well, Dale, why don't you just buy five options or sell 5 credit spread? I could do that, but now all of a sudden you have 5 times the commission. You have 5 times the commission. The other thing, with a credit spread of only 19 cents, what happens if you have some slippage? What happens if you put in a trade for 19 and you get it at 17? What happens if you know, it moves a little bit once you get in there? Then you've got some commission on top of that. All of a sudden your 19 cents is eroded down to 12 cents. That's a big difference. Let's say you've got 7 cents erosion here from slippage commission. Let's say you have 7 cents up here. That's still $1.03 worth of credit. This dropped to 12 cents. This is still $1.03. I only trade the big five, Amazon, Google, Priceline, Google Class A, Priceline, RUT, and the SPX. And there's only a couple indicators that I use. I've been doing this for a long time. These indicators serve me extremely well. The first one is the regression channel. This regression channel tells me when something is overbought and when it's oversold. The regression channel, the purple line is the regression line. It is calculated by 50% of the price being above and 50% of the price being below. It's an excellent trend line. The green line is the plus or minus 1 standard deviation. I think I've got a standard deviation bell curve I'll show you here in a second. The gold one is plus or minus 2 standard deviation. Okay, usually only about 66% of the time will it go outside of the boundaries of the +1 and the -1. 95% are contained within the +2 and -2. This is the casing of the sausage, and this is the meat. If the meat gets close to squeezing out, you know that it's going to revert back to the mean. You know it does. Time and time it does this again. Yeah, occasionally you will get an outlier. But an outlier, as soon as it turns around, gets sucked back harder. And most times when you come down, it gets sucked back and overshoots to the other direction. But it always reverts back to the mean. The other thing I look at is my own version of the daily version of the weekly MACD. When this shows me that it's overbought or oversold, I look for a confirmation here of a change of color and a ready, set, go before I will jump in. Pretty simple indicators that I've been using for a long time. Quickly, here's what the MACD is. The MACD is the 12-period exponential moving average minus the 26-period. And they are 2 lines. There's 2 lines. The signal line is the 9-period, and if you measure the distance between these, that's how they come up with this histogram. The MACD has been used, it was developed many years ago. A lot of people follow this. The only problem I have with it on a day-to-day basis is you get whipsawed. These are, yes, they indeed are lagging indicators. They indeed are lagging indicators. If you know of an indicator that will tell you what tomorrow's newspaper has to say, I would love to know about it. There is none. There is none. The very best you can do is pick a combination of lagging indicators that predict as best you know what might happen in the future, prepare yourself with a trade that doesn't necessarily have to go in that direction and manage it accordingly. Okay, again, the regression channel is, we got the regression line, the plus or minus 1, and here is the bell-shaped curve. I don't want you to all become statisticians. You don't need to. What you need to understand is that if we look at price between the -1 and the +1 on the standard deviation of the regression line, 68.2% of all prices are contained within that. And then when you go to the -2 and the +2, you're looking at greater than 95% of all prices will be contained within that. Okay, a question here, could you repeat the standard deviation, please? Dudney, I hope that that chart right there explains what I was talking about back on the regression line. And then here's the +1, -1, +2, -2, and most of the prices contained within there. So when you get something that's up around here, you know that there's a good probability that when the macro MACD shows that it's coming back down, it's going to revert back to the mean. Okay, and that's how I use the standard deviation. I hope that clarifies that for you. Okay, here's the trading rules I use. They're pretty easy. If you recall the chart that I showed you earlier, on the left-hand side, I use the 1-year week. And first of all, I look for a price that's overbought or oversold. Then I go over to the right-hand side, and for the MACD, I'm looking for a ready, which is a change of color, a set, which is a higher high, and a go, which is a continuation in the direction of trade. This ready, set, go has saved me a lot of losing trades. I'm looking for something, one, that is going to revert back to the mean, but then two, I'm looking for something that is actually telling me that the change is starting, and not only is starting, but it's happening, and it's going to continue on for a while. I always avoid earnings. Earnings is unbelievable. If any of you watched the price line earnings, let me see if I can bring that up real quick. Here's the big five. Here's price line. Look at this. Look at these earnings. Now, what I find interesting is they actually beat the street. The earnings was $15.14. The estimation was $14. So they beat the street on the earnings, and look at it, got clobbered. It got clobbered. Why did that happen? It happens all the time. Investors, the big institutions and so forth, don't care about the earnings. That's past news. That was all reflected back in here. Okay, this is forward guidance. That's what we want to do. We want to know what forward guidance is. And in earnings, you have no clue unless you have inside information, at which times maybe the SEC would be interested in talking to you. So I always avoid earnings. You never know what's going to happen. Step 4, that should be sell. I sell a bear call, a bull put, about 30 days until expiration. I always want an open interest of greater than 100 because that's going to give me a good bid-ask spread. I'm going to ask the 4 traders to give me a midpoint of both of those trades. Step 5 is I'm going to exit with about a 10% profit or a loss of 6%, which equates to 100% or 60% loss. And I'm going to use the risk profile to do that on the Analyze tab. So let's look at some actual trades. These are trades that I closed just a couple months ago. Got a Google trade, and this Google trade was a bull put right here. The market was heading up, and it had been down here, so I was looking for a bull put. I sold the 16 June 920 and bought the 910 further out of the money and got $1.23 credit. I bought it back at 18 cents. Okay, 115% profit. Okay, based on a dollar, grabbing a dollar. A dollar would be 100% profit. I had $1.15 on this trade. So let's look at Amazon. This was the trade that I made back here. This was a bear call, and what I was looking at here is that it was, see, Amazon, Google, and Priceline, I very seldom see them go to the +2 or the -2. If they do, boy, I am licking my chops, because they don't deviate from the regression line very much. But back in June 12th, I was looking at this and I said, this is overbought at this point. It's probably going to revert back to the mean. So what I want to do is I want to sell the 1050 and buy the 1060 for a bear call for $1.20 credit. Now let's watch what happened here. This is where I sold. And for the first 5 trading days, it was going in the wrong direction. Then it went sideways, and then it finally went down. I didn't take it all the way down, because the debit, it was down to 12 cents right here. The debit had dropped to 12 cents. I never take a trade all the way to expiration. Too much can happen, too much risk. And most times when I reach my goal, I get out, because I want to avoid that risk. Okay. Why do you do credit spreads a month out versus using weekly options? And that's an excellent question, Deborah. I do both. And you'll see there's 2 programs that I do. One is called Options Pro, the other is called SPX War. SPX War, basically what I'm looking at is the same strategy on the SPX only weekly options. It's a little faster pace. It's more trades. You have to be a little bit more active. It's for those who want that fast pace. The returns are about the same as what I'm teaching you right here, what I'm showing you right here. And this is Options Pro. This is monthly income on a consistent basis. So I do both, Deborah. And that was astute of you to look at that and say, well, why not do this on short term? Absolutely. But it's gotta fit with your schedule. A lot of people don't want to be that active, but they want to have the returns, and that's what this one's all about. Okay, the last one is an XSPX on July of this year. We set up this trade, and that was actually right here. You can see that it was oversold at this point. Not a great deal, but these things hug the regression line pretty close. And then what I saw here is that the color changed from red to green. Ready. That was a ready day. Set, higher high, go. That was my entrance day, okay? Then it went in the direction, and now, right now, it went, this is the Fibonacci's, that's the other tool I use to exit. It's been sitting at this Fibonacci level for ever since, you know, what was this date? This date looks like it was right around the 1st of August. It's about ready to expire. It expires this Thursday. This is the monthly. This the 18 August is the monthly bull put where we sold the 2410, bought the 2400, got a $1.05 credit. Currently that is sitting at about 20 cents credit. Okay, so we've got 85 cents, or about 85% of the dollar that we're looking for. Okay, and that's but at this point in time, with only 2 days left, and it's still sitting up here. Let me take a peek at where it is right now. The SPX is let me bring this over and show you where it is. The SPX is up just slightly today, but you can see the chart I showed you is it started back up, it went sideways, and then it dropped like a rock. And now it's back up here with 2 days left till expiration, and we're probably going to take 100% off the table here. And this is a trade that went in our direction, went sideways, went against this. Now it's going with us, and we're going to make about 100%. When credit spreads are done right, they are just the absolute best way to do things. All right, so what I want you to do is I want you to become a free member of my website. I want you to begin learning by being a free member. And that is, again, www.optionsinfinity.com. All you do is click on the free membership, and I'm going to show you how to do that. And then if you want to, if it looks like this fits your eye, it fits your timing, it fits, you like what I have to say, you might want to join either Options Pro, which is the monthly, or the SPX Weekly Option Regression, SPX War, which is the weeklies. You can learn more about those. Like I said, both of these are closed right now. I only have so many that I will allow into my trading sessions. I like to focus on the people. You get my email. You can contact me directly, and I answer a lot of questions on an individual basis like that. And I want to keep it small. Let's take a look at my website, www.optionsinfinity.com. When you go onto the website, this is what you'll see. If you scroll down, you can see that here's my two programs, Options Pro, SPX War. And these are some of the specs on both of those. You can see that SPX, you get more, there's more actions, there's less holding time. The returns are very similar. Okay, now as a free member, here you get free webinars. I want to teach you everything you need to know about options trading, how to set up your charts, what's the proper trade size for your portfolio, a little bit on the psychology of trading, a lost art, something that really has turned my trading around. More on the regression channel, more about Fibonacci and measured moves, what the macro MACD is, credit spreads, weekly options, a little bit more on those. Become a free member. Here's what some of the members have to say. And let's say you become a free member and you're going around and you say, you know, this makes sense to me. I want to do this. All you have to do is come right here, say find out more. When you find out more, it's going to take you to the home page of Options Pro, and it's going to come up with a little form here. If you want to be, and there's no obligation here, you want to join the list, there's only a few spaces available. We are going to open that up August 20th, which is next Sunday. Just put your name and email on that. You'll be alerted when the window is open for you to join. Let me go over further and tell you what you get. Okay, you're going to get a 4-part credit spread system mastery course. This is about 2 hours of training. Every night I do a trading session review. What happened in the market today, what I see for tomorrow, what's going on. When I see a trade that I want to make, I send out a real-time text and an email alert. I am not a registered investment advisor. I'm not a licensed broker. What I do is when I send out a real-time text and email alert, it's what I am doing. You have to be the one that pulls the trigger. This is what I am doing. And then once a month you get together with me, I'm the teacher, and I sit down with you every third Tuesday for an hour, and we go over Q&A. And that's all included in there. It's $99 a month. You can cancel anytime. You can't beat it. You're not going to find anything more powerful and more educational than what we have available on www.optionsinfinity.com.